Hi, hello everyone. This is Sam Wong again from Financial Services Analytics Team LLC. Hope you had a great weekend so far. The market wasn't doing too well the last couple of days, and you probably noticed stock fell as more than 2 trillion worth of option tied to the S&P 500 single stocks and other index were expiring. The moves left the S&P 500 down for the first week after 4 weeks of advances. So you can look in the S&P 500. I mean, it wasn't down a lot, but in particularly, actually, if you look at the first couple of days, they have volatility, but overall the direction is still up. But then, you really have slipping down at the retail stock wasn't reporting as great as expected. Uh, less that the moves, the S&P 500 nearly reached a 200 line before slipping back. It wasn't the empirical rejection while the benchmark index closing slightly higher, just below the key level. The Leicester has a little distance to reach a 200-day. That was prior, around Tuesday, but then it was slipping back again. Again, there was some resistance over that area. But we know that the stock market, while it's hovering around key resistance now, with some rotation, at least in the short run, to natural gas, real and other real economy names, while growth step back as well. Investors should continue to be cautious about adding exposure, building up your watch list, and make sure you have a diverse list of coin names setting up. Market, if you look at it, in three major indices, doesn't matter which one you're, they all a lot of time running the same kind of trend and directions. They start with a good momentum, but with disappointing retail earning outlook, market reverse were concerned potential Fed rate hikes. So at the time, last week and even up to the point of February, Tuesday, it was still expected. A lot of people, analysts, thinking it would be 0.50% rate hikes in September. But now the people with the what happening with the retail industry, we announcing earning now expected potential could be 0.75%. So that's really making the market kind of pull back. Disney Wall Street last week with a strong earnings then to solid Disney Plus subscriber gain a healthy theme park attendance. So the stock actually, if you notice, it rally from the low point of hundreds and back up to a pretty strong 120, but there's still a long way to go. At least it should have gone to 150. Then I think that's probably around the right level. The reason uptick were also driven by Saudi Aramco powering into big cap U.S. stock like Alphabet, Microsoft, and Amazon. I mean, $7.5 billion spending from a lots of oil profits. As you know, oil prices really, even in compared June to July, have kind of pulled back a lot. But earlier of the in May prior, the oil prices really had jumped up 25% or more. Both Home Depot and Walmart report earnings that beat expectation with Target and Lowe's slated to report on Wednesday. Coal fell more than 8% and Chester Tree slipped about 1% pre-market trading. Target fell 2.7% Wednesday after reporting a nearly 90% plunge in second quarter profit. Bed Bath and Beyond is kind of interesting. Skywalker and me revive interest in the mimic stock. BBBY, which is the symbols, shot up 29% to 2065 in the record volume, but took a hit Friday. Friday share after our trading at $9.58. So you can see a big hit. You just like AMC, right? Sometimes you push it up to $20 and then you pretty much lost half in 2 3 days. Retailers have warned through a high inflation will discourage consumers from spending on non-essentials. Several big technology companies were lower, with the notable exception of Cisco System, which turned into stronger than expected quarter result. However, Foot Locker, symbol FL, was upgraded by analysts at the Bank of America from an underperformed rating to a neutral rating. They now have a $43 price target on the stock. On the other hand, which is something that also worth noting, Tesla. You can see the stock, the strong rally up from August 11, which is here. You can see a really huge spike up there, and really hit over $900, and coming back down big on Friday, which come back to the going back to the August 1st price level. So if the stock go down, to me about maybe a little more, then you probably worth looking consider buying, because again, August 24th is the day they are expected to be split. Credit rating agencies said a moderate slowdown is still the more likely outcome, predicting that housing activity will fall by mid-single digit in 2023 and no single digit in 2024. And part of it is because the rate hike, which causing the mortgage rate higher and also harder to get credit for borrowing to buy a house. U.S. home prices have already declined steadily during the summer months. U.S. home prices could sink as much as 15%. Some people predicted that. Though the housing market slowed down, the median cost of monthly rent is now over $2,000 for the first time ever. In New York City, landlord generally ask that renter make an annual salary equal to 40 times their rent. That means the median renter in Manhattan is expected to make $166,000 a year. Just to give you a math and get some idea. The median household income to New York is only $67,000. A further acceleration in U.S. wage growth could put portion set to reduce industrials per share earning by 1.4%, as I said. Meanwhile, just switching to energy, the American Petroleum Institute (API) reported a draw this week for crude oil 448,000 barrels, while analysts predict small draw 117,000 barrels. Energy prices have dropped significantly over the last 2 months, dragging the top line inflation number down along with them, but the cost of food, shelter, and nearly every other commodity is still increasing. WTI is trading down Tuesday on disappointing economic data out of China and the improving process of reaching a nuclear deal with Iran. The prices fell by pair losses. West Texas Intermediate, which WTI crude slipped 0.1% to $90.41 per barrel Friday. Brent oil, the international benchmark shade 0.39634. The US dollar index climbed to a fresh 1 month high, while gold dropped to 1760 and Bitcoin continued fell under 21,500. Overall, for the month, if you look at the index, which is 5 days, in a month perspective, it really over Dow Jones was flat, and Dow Jones was flat, but then if you look at the NASDAQ, it's down a bit, 2%, 2.2%, which is a little bit higher, and S&P 500 kind of less than 1%, so it wasn't very lot. Part of it is again because of the disappointing retail sales that driving the market down, and again S&P 500 industrial and consumer stocks set to take the biggest hit from the higher labor costs, according to Goldman Sachs. The U.S. job market has shown remarkable resilience in the face of 4-decade high inflation, 2 straight quarters of economic contraction. Mixed economic signal drove market volatility. You may have noticed that the small cap and high tech stock actually, from last week or so, when the market started reporting earnings, all the small cap and high tech stock actually growth have a very strong momentum rebounding from June low. But then, last couple of days, just today, it kind of retreated probably 10 to 12% already. Still the rate hikes and recession concerns. So it may be a buying opportunity again now between now and September rate hikes, because I think the market may not necessarily receiving more good news, and it all depends on the forward looking and the outlook of whether inflation will be in control, how the labor market going. So also there's some political concern as well, the macroeconomic factors with the tension again between US and China and so on. And also COVID-19, obviously, a lot of time news not talking about it, but still ongoing, which driving the supply and demand on the world, and also how open the economy is overall globally. China still kind of struggle with that, but hopefully the economic growth will be better than last reported. So depending how your portfolio position, so maybe looking for another drop 10% or so before buying back, and wait for September where the hikes hopefully will be kind of pricing in with a 0.75% for the market reaction in the last couple of days. If you're really lower than that, or even if it's expected, then maybe this is. Maybe if you look at which will be next video next week or so, I will kind of show you the trend of the market to help you understanding what the prediction going to be after the September rate hikes. Hope you have a great and wonderful weekend. Again, the strategy is buy the dip, sell at the strength.